Welcome to the latest Hardman Talks, where we're going to discuss the interim results from Chesnara. I'm delighted to be joined by Steve Murray and Dave Rimmington from Chesnara. They're going to start with a short presentation, and then we will follow that with a Q&A.
Thanks, Brian, and thanks everybody for dialing in to listen to the presentation. We're going to talk for about 10 or 15 minutes, giving you a bit of background about Chesnara, what you should expect from us with a focus on our half-year results. So on the slide here, these are the four things which we like to talk to investors, whether they be debt investors or equity investors, about the Chesnara story and what you can expect from us. So the first point is that we deliver economic value from a number of different areas, and that supports the long-term cash generation that we have from the business, and that leads to us paying a very healthy dividend for shareholders. Secondly, we've got a strong balance sheet that's proved to be highly resilient to market volatility, and we've seen that again at the half year. Thirdly, one of the unique things about Chesnara is we do seek out value-adding acquisitions, and we've got a proven track record of delivering value through integrations and adding growth to the company. And finally, we've got an experienced management team and board that's very focused on sustainable shareholder value creation. So let's now look a little bit at what we've been doing over the last 6 months. So it's been a busy time right the way across Chesnara. Firstly, on acquisitions, we've completed the acquisitions of Conservatrix, an insurance portfolio in the Netherlands, in the first half of the year. And we also announced the acquisition of a protection portfolio from Canada Life in the UK. That reinsurance agreement that as part of that protection portfolio was in place on the 16th of May and is now in the company's results. And whilst Dave will talk about the financial results in a little bit more detail, I did want to highlight that all of our core metrics moved in the right direction in the half year. We saw positive cash generation, we saw our balance sheet strength improve, we saw embedded value growth as well during the period, and that led to an increase in the dividend again of 3%, and that's the 19th consecutive year that we've increased the dividend for shareholders. On the operations side, it's also been a busy time at Chesnara. We signed a new outsourcing partnership with SS&C for our UK business, which will enhance the size and scale and capability that we can access for the UK. We implemented IFRS 17 reporting for the first time in the half year, and Dave will cover those results shortly. And all of the transition and integration activity that we have in place across the 4 acquisitions that we've executed in the last couple of years remains on track. On the people side, we announced a new CEO for Skilden and a new chief executive for the UK business as well, both of whom started in September. And we're well underway with a market search for a new chief executive for Movestic as well. And on the sustainability side, we remain committed to becoming a sustainable Chesnara. Earlier on in the year, we announced for the first time targets that we're going to meet going forward, including net zero. We're making very good progress with regards to our 2023 objectives and developing the longer plans that we need to become a sustainable Chesnara. Now, given the level of M&A activity that we've had over the last wee while, we put this slide up for investors at the half year to make sure that they understood the progress that we're making on integrations. Helpfully, all of those integrations are either on track or complete, as you can see from the slides below, and we're expecting meaningful cash generation and DCV from those acquisitions. So when we look at all of the acquisitions in totality, we're expecting cash generation of around 30 million per annum to come into the organisation. And also at the half year, we show that the ECV gains that we're expecting from a number of our acquisitions had also increased. And we believe we're well positioned for further M&A, and we've got the capacity to do additional M&A from this point going forward. So with that, I'll hand over to Dave, and he'll talk about the half-year numbers in a little bit more detail. Over to you, Dave.
Thank you, Steve. Right, I'll start by just providing a bit of context to the results, because as some of you may be aware, the Chesnara results can be relatively sensitive to external market conditions. So on this slide, I picked 4 of those external economic factors, and you can see that during the first half of 2023, we saw strong recovery in equity markets across all of our territories. We saw interest rates continue to increase, particularly in the UK. Sterling strengthened against two of our key currencies, which is the Swedish krona and euros. And finally, credit spreads were relatively neutral over the period. So what's this done to our results? So you can see here how these economic factors have impacted our two key financial KPIs, which is cash generation and economic value. The equity growth is positive to both long-term economic value, but also a positive impact on cash generation in the period. Similarly, yield increases are positive, less so on economic value, but create a significant growth in surplus stroke cash generation. As I said, credit spreads were relatively neutral, so no surprise, there's no major impacts there. And then finally, FX, the strengthening of the pound against both of our subsidiaries currencies has had a relatively notable negative impact on economic value, but we're well hedged in terms of cash generation. So bearing those impacts in mind, I will now just have a couple of minutes on the overall scorecard and then take you through three of the KPIs in a little bit more detail. So this is the overall scorecard. It's relatively unique in the sense that nearly all of the KPIs and alternative performance metrics are positive. There's a strong cash generation, as Steve mentioned. If we focus on commercial cash, which tends to look through some of the more technical components of Solvency II, you can see at a group level, there's 21.8 million for the half year. Decent IFRS profits, and I'll come back onto those shortly because we've had the inaugural IFRS 17 figures. Good new business results, and importantly, a growth in economic value and very strong solvency. So pretty much a clean sweep of positive KPIs. If I just now dive into three of them in a little bit more detail. So starting with cash generation, you can see here that commercial cash, both at a divisional and group level, is strong. The 21.8, which includes the benefits from an FX hedge, more than covers on an annualized basis the 2022 dividend and coupon payments. So the Chesnara model, which is built upon this recurring level of cash generation, remains strong and has done in the first half of the year. Looking on to economic value, again, you can see a notable increase in economic value. To the left-hand side of this chart, you can see total economic value earnings of 61 million, a particularly strong period. Two main contributing factors: real-world returns of 31.6 because of the positive economic conditions I referred to earlier, but also notably 28 million of value growth as a result of the acquisitions which completed in the period. So a really strong period of economic value growth. Against that, we've seen a negative FX impact I referred to earlier. And of course, the dividend payments we make to our shareholders bring down economic value. So even with those two outflows, we've seen a net increase in economic value, which is a positive achievement. So last but not least, moving on to IFRS. Historically, the IFRS results have had little relevance to Chesnara. And we've always tended to tell investors that actually, and we still continue to do this actually, solvency metrics and economic value remain the most commercially relevant metrics. But with the advent of IFRS 17, the IFRS results are of more relevance. So what we've seen as we've moved from IFRS 4 to 17, we've seen an increase in our net equity, which is positive. And we've also seen the creation of something called the contractual service margin, which stands at 157 million at the half year. And this represents a source of future insurance contract profits. So on a total level, if you take the contractual service margin and add it to the net assets, we've seen a significant reduction in our leverage ratio compared to the figure we reported at the end of 2022. This is what we expected to see, but it's a very positive outcome of the transition. Just a quick reminder that actually only about half of our portfolio is actually in scope of IFRS 17. And IFRS 17 is useful and it's changed the numbers, but what it hasn't done, it's not changed the value of the group, it's not changed the dividend expectation. So in terms of those really true commercial drivers of the business, IFRS 17 has had no impact. Looking at IFRS 17 from a P&L point of view, the results are now more intuitive. You can see how much of your profit is coming from your insurance portfolio. So you can see a really welcome profit of 9.5 million in the half year. You can then see an investment component, which is more volatile, almost by definition. But as I said earlier, the economic conditions were positive. So we saw a nice investment result coming through. and then a series of more traditional fees in versus expenses out, coming to an overall profit of 16 million for the year. Now, what's important is when you look at IFRS 17 profits, you need to do that in conjunction with looking at the movement in the CSM, this future profit store. So what we've seen is not only a profit in the period, but we've also seen a significant increase in the CSM of moving from 103 million at the start of the period to over 157. So both profit posted and growth in CSM have led to a really positive set of results on an IFRS 17 basis.
So as both Dave and I touched on up front in the presentation, one of the ways that we can grow the value of Chesnara is by bringing value accretive acquisitions into the group. We've done that successfully in the first half of the year, but also over the history of Chesnara as well. And what we set out in this slide is our view of some of the key drivers that are meaning that we see positive prospects for future M&A to happen in our markets. And if I was going to pick 2 or 3 of the main drivers, I'd pick out operational simplicity. We're seeing a number of large global insurers try to simplify their operations, move their strategies perhaps away from their legacy, and that's creating opportunities for us to acquire books. Secondly, we are also seeing global insurers trying to recycle capital from non-core products to invest, for example, in the UK BPA opportunity. And thirdly, we're also seeing people be a bit more discerning about the geographies that they now want to operate in. And when you combine those things together, that's leading to a very healthy pipeline, certainly in the UK and the Netherlands. And we're also exploring opportunities in Sweden as well to see if there could be acquisitions that we could do in that market in the future. One of the other trends that we've seen in the last couple of years is a move away from the disposal of whole legal entities to portfolio sales. And you can see the recent M&A activity that we show on the right-hand side of this slide, where the majority of transactions are extracting smaller books of business from an existing legal entity. And that's good for Chesnara because we already have existing operations, legal entities, and also strong relationships with regulators, meaning that we can handle those portfolio transactions in a way that perhaps others that aren't in those markets aren't able to do. Looking at how we're positioned then to take advantage of these opportunities. We have a strong track record of customer service. We can manage a very wide range of products. We've got strong relationships with regulators, and we're also very flexible in terms of the way that we can approach M&A. And on the bottom of the slide, you can also see that we've got material financing power available at our disposal. And we've got readily available cash, including the RCF that we have a group of over 200 million to potentially deploy on M&A. And that's supported by our investment grade rating that we have from Fitch. And I talked about flexibility. We will also consider different ways of financing transactions or actually partnering with people on bigger books of business as well. So overall, we see positive prospects for Chesnara to compete on M&A, and we're seeing positive prospects for the business overall, particularly off the back of a good set of half-year results. So with that, I'll hand back to you, Brian.
Thanks very much, Steve. What I'd like to do now is do a short Q&A. So Steve, I'd like to perhaps start with where you finished in terms of M&A. And you mentioned you've got several deals sort of been progressing well. I think the Canada Life one is the most recent one, and I'd like to know how that is progressing. And maybe we could make reference to you've got the new relationship with SS&C in the UK, which I think is tied in with that.
Yes, so it's thanks for highlighting that, Brian. You're right. The last deal that we announced back in May was the acquisition of that UK protection book from Canada Life. The planning is progressing well. We are going to be moving those policies onto that SS&C platform in the fullness of time. And I think what that new strategic partnership gives us is access to a global technology firm, all the sort of skills and capability that they have, and actually working in partnership with them to see if we can go and consolidate other books in the UK space. So whilst it's early days in that relationship, we're very hopeful that longer term partnership really will be a helpful supporting factor for our M&A strategy in the UK. And as I mentioned in my presentation, Brian, I mean, Canada Life's quite a good example of some of the trends that we're seeing across markets, where you have a very large global insurer in the shape of Great West that owns Canada Life in the UK. looking at the geographies that it wants to be present in, the UK business itself, looking at its strategy and trying to move more into wealth, and deciding actually that this smaller business that had started a few years ago probably wasn't worth the effort. So we were very pleased to be able to find a solution for that portfolio and work in partnership with Canada Life on that. But we think it's quite a good example of a number of the trends we're seeing, and it was a portfolio transfer out of the main legal entity that they have in the UK.
Good. Everybody always obviously wants to know where and when the next deal is going to be, which we can't actually know. But I think if we look at what's been happening over the last sort of few months, you've indicated that your integrations in the Netherlands in particular are complete, and the UK ones are sort of in progress. And the natural question, does that mean that the overseas sort of locations are perhaps more attractive for deals in the near future?
We're very happy to look at deals across the different territories that we have. I think you're right to say that the integration is a bit further progressed in the Netherlands, and Lawrence and the team that run VARD, which is our closed book consolidator in the Netherlands, have done a very good job in terms of working through that. So we certainly feel we're kind of open to new acquisitions there, but that doesn't rule out us doing things in the UK as well. We still believe we're on track to do the Part 7 of the SLP business into the countrywide legal entity that we have, which is a major milestone for us. And we're working with SS&C in terms of the kind of choreographing of the various migrations that we've got in place to ensure that we would have the operational bandwidth to do something bigger. So we'll look at these things in the usual way, Brian. What does it do to cash generation? Does it kind of enhance the embedded value of the group? What does it do to solvency? And how does it add to that overall dividend paying capacity that we have? And how does it support that 19-year unbroken track record that we have of increasing the dividends? And we're seeing good opportunities across both of our main territories for M&A at the moment.
I've got a couple of questions that I'll maybe address to Dave now. We saw solvency increase again. And I think it might be better explaining why is solvency so strong and continuing to increase.
I think there's some important features here. I think what's really important to note is that the BAU performance, so the first two charts on this waterfall of 2 and 8. So the business in its own right continues to create surplus and the solvency grows. We've then got this. And those items in themselves are actually more than sufficient to fund the dividend payment from a solvency perspective. We then have got some exceptional items during this period, the largest one being the impact of how we valued the Tier 2 loan on the balance sheet. When we first raised the Tier 2, we valued it at book value, effectively its full book value of 200 million. We've subsequently investigated what was probably best practice for valuing of those type of assets, and we've moved to a fair value accounting basis, which, because the way interest rates have moved since we've raised that Tier 2 debt, the fair value of that asset stroke liability is lower. Now, why that helps solvency is because at that lower value, more of it is eligible for solvency purposes because there's a solvency restriction. So what's happened by being more effectively more correct in how we value that Tier 2 asset, we've created an increase in our solvency ratio. The other material point to note is the acquisitions. I think, as we've said many times, often acquisitions can have a negative impact on solvency on day one. Over time, of course, you expect then to create surplus from that acquired business and you go into a positive position. So that has been the case, actually. And these are relatively small impacts and way within what we would have expected. But we have seen a small negative impact on the headline solvency ratio as a result of the completion of the Conservatrix and the Canada Life deals. Actually, of note, it's a small number, but rather uniquely, the Canada Life deal actually led to an increase in solvency ratio. So that's the solvency story. So it's a bundle of positive BAU performance, impacts of M&A, and a rather technical one-off impact of how we're valuing the Tier 2 asset.
And I think the other area which would be of real interest to a lot of investors is about dividends, and in particular, maybe want to ask about internal dividends, because we've seen a lot of strong dividends from the operating businesses, from the individual divisions recently. And I think the inevitable question that people ask is kind of how sustainable are these?
You're right. It was a particularly healthy dividend flow flowing up to the parent company in the first half of 2023. And it is sustainable. I think the best chart to illustrate that sustainability is the chart on the screen now, page 15, which shows basically where we see future source of cash generation. And what this slide is illustrating is that we have a line of sight through three major sources: risk margin and SCR runoff, real world investment returns, and management actions. Cumulative, we see from those sources over 300 million of cash generation, which will take the form ultimately of dividends flowing from the divisions up to the parent company. And that more than covers the expected level of dividend and debt servicing outflows over that same period. So exactly how that cash arises on a period by period basis can be slightly more volatile at times, but on a cumulative steady state basis, we've got a line of sight for significant future cash, which means we're very confident that those dividends will continue to flow.
That sounds great. I'd like to ask about Movestic, because over the last sort of couple of years, it's had some operational challenges, and this year we saw significant improvements. I'm just wondering if you can maybe just highlight a couple of things about that, because I think it bears a little bit of explanation.
Yeah, so it's interesting. So there have been some challenges in Movestic. They're kind of operational, but in a sense, they're probably also market driven. And it was we had a period where there was a level of transfers out from the business driven by competitor pricing, which was unwelcome, and it happened for over a year. And what's happened, Brian, is a little bit more normality has come to the market pricing. We've also then improved how we manage transfers, so that the effectively the transfer ratio, which is the ratio between transfers coming into the business compared to the level of business transferring out, is vastly improved. In fact, for the first half of 23, that's gone positive, and that's continued on a really positive trend into the second half of the year. So I think it's a combination of the market becoming more sensible, combined with our better experience and better capability of having playing a positive role in that transfer market, both on the ins and the outs.
Excellent. And the last question I want to ask is about expenses, because obviously we've seen a growth in expenses. We've also seen high background inflation over the last sort of year, 18 months. How has that affected what your business and what's going on?
Expenses in total have increased. Actually, the inflationary pressure in this period's results was relatively small, and that's because we'd already provided for a level of recurring inflation. But in terms of the absolute cost base, there's been some inflationary pressure, definitely within appetite and within control. We've also invested a little bit more on in the future, in essence, strengthening some of the capabilities on the M&A front, investing some one-off money in the deals, both the deals which have completed and maybe some of the deals where we've taken them to a certain point and for whatever reason not progressed. So there's an exceptional investment component to the expenditure. There's also one further dynamic worth mentioning is that SLP, Sanlam, where for a temporary period the cost base can be higher. So we're operating to a transitional service arrangement on Sanlam, and as we come out of that transitional service arrangement and move on to the long-term rate card with SS&C, we will see a significant reduction in that cost base. So there's a bit of a temporary nature to the cost base. There's a level of investment in the future and a modest but manageable inflationary pressure.
Okay. Steve, would you like to give any final words?
Thanks, Brian. Well, as hopefully you can see from the presentation today and some of our answers to Brian's excellent questions, we believe the business is in a good position. We've delivered strong cash generation. We've improved the new business profits across the group. We've grown the embedded value of the company in the first half of the year significantly from a number of different sources, but particularly from the acquisitions that we've made over the last couple of years. That's supported by a strong and resilient balance sheet with solvency currently at 205% at the half year. And we're making good progress with a number of operational programs, including the broader sustainability program that we have in place as well. So overall, we continue to believe that there's a lot to look forward to here at Chesnara.
Thank you very much, Steve. Thank you, Dave. And thank you to everybody for joining the webinar. If you want to learn more or read more or contact us, you can follow the link in the show notes, which will have a link to the research note that we wrote. Alternatively, you can contact us by email or on social media. Thank you very much and see you soon.